Hello, welcome to this episode of Rich Insights. I'm Don Rich, Head of Investments for Esoteric Capital Markets. Today's topic is on paying for the virus. Just how much is the virus costing? How much are we spending on all these monetary and fiscal stimulus plans? Well, we got our first indication this week. Here we have a picture of the Treasury Secretary, and the Treasury says we will borrow $3 trillion. That's right, folks. $3 trillion in June. $3 trillion in one quarter. Wow. $3 trillion. Let's try to put that in perspective. First of all, there's about 330 million people in the U.S. So we're talking about 10 grand, right? 10 large per person to pay for the virus. Now, this is nothing more than just a virus alone. 10 grand per person. Now, how does that $3 trillion in one quarter compare? Well, we've never have seen anything like it. It's nearly 5 times the next largest amount. The previous peak was in 2008. 5 times that amount. And we're not done. That is certainly not the end of this. Right? That $3 trillion is going to pay for the fiscal stimulus checks that are being sent to individuals, to pay for the expanded healthcare costs, and the small business loans. Those are the 3 big categories. Now, we may need additional stimulus going forward, depending on how quickly we reopen, how quickly the economy grows. So $3 trillion is not the end. Wow. Now let's just keep going with this. If that amount's not staggering enough, last year alone, we spent $1.3 trillion more than we made. We are just living so far beyond our means right now. We spent $1.3 trillion last year, more than we made. This year, we were on schedule to spend more than we make. All right? So we got $3 trillion just for the package so far. We might need additional stimulus measures, plus we got the remainder of the year to pay for. These are huge numbers. So what's going to be the effect of this on investments? And when I think about that, think about the implications. 4 questions come to mind for me. The first one here: will this cause interest rates to rise? Number 2, what will be the effect on inflation? What will be the effect on currencies, right? Number 3. And what will be the effect on gold and other precious metals, right? Number 4. So what I want to do is go through each one of these and discuss them. All right, so your gut reaction would tell you, if you're issuing a lot more debt, interest rates would have to rise. Right? Bondholders would demand a higher rate of return. So you would think rates have to rise. I don't think that's going to happen now. That's what you'd expect to happen. I don't think that's going to happen. In fact, since this $3 trillion number was announced last week, interest rates have continued to go down. Not up, but they have gone down. And I expect that trend to continue. Right? Now, why is that? Well, before the $3 trillion, we had somewhere between $24 and $25 trillion outstanding, right? That's the total debt the U.S. owes. Let's call it $25 trillion, rounded up. Plus the 3, right? Now we're up to 28. So the first reason I don't think interest rates are going to rise is a practicality constraint. We can't freaking afford it. We can't afford higher interest rates. We just cannot afford it. $25 trillion plus 3, 28. That thing would just skyrocket if rates were to climb. All right. So I don't think that's going to happen. Now, how do you prevent that from happening? Again, you get back to quantitative easing, where the central banks are repressing interest rates. So that's how you can make that happen. The second reason I don't think interest rates are going to rise from here is related to the first one, something called debt deflation. Debt deflation. Right. In fact, I think not only interest rates not going to rise, I think interest rates are going to go negative, like they are in other countries, in Europe, and they have been in Japan and so forth. Negative interest rates allow us to deflate that $28 trillion in debt. Now, what is that? Well, what are you talking about here, fat man? Well, it's actually very simple. When the debt comes due, you roll it over with new debt, right? And that new debt is cheaper when interest rates are lower. That's called debt deflation. So I think that's going to be the second major reason why interest rates are not going to rise in response to this. All right, what do we got here? Your second issue, second question. What will be the effect on inflation? Again, you would think inflation would have to rise. That would be your initial reaction, your gut reaction. You're just going to flood the world with a lot more dollars, and you would think that inflation would have to rise in response to that. I think on one hand, I think the Fed would actually welcome that inflation if it was to come, because I think the main concern right now is not inflation, it's deflation. Right. So I think the Fed would like it if it would happen, but I don't think it's going to happen. I don't think we're going to get inflation from this. Now, why is that? Well, let's go through. Obviously, we've got tremendous slack in the manufacturing sector, and we have had for the last number of years. Right. What about slack in the labor market? Well, everybody's been expecting labor costs to rise the past few years. Right. Most states have increased minimum wage. It was the tightest labor market in 50 years, yada, yada, yada. Wages have to rise, right? No. I kept saying at the time, I didn't think that was going to happen due to the demographics. Right. We're shoving the old codgers out like myself and putting the new kids in, and the new kids are making far less money than the old codgers. So that was going to be more than offsetting the minimum wage effect. All right. So we haven't seen any wage inflation, and certainly in this current environment, I wouldn't expect anybody to be raising salaries. So we got all kinds of slack in the manufacturing market. We have plenty of slack in the labor market. We're also going to receive the tailwind from lower commodity prices. That's also going to keep inflation in check. And then I would add to that, we're every day we're more and more of a tech-based society. And of course, technology, we know it just keeps getting cheaper and cheaper over time. Right? Think about, the cost of, say, a television 2 years ago versus recently, or the cost of, a laptop computer or anything like that. So for all those reasons, I think inflation is going to remain low here. All right, so will interest rates rise? I don't think they will. Will inflation go up? I don't think so. What about currency? What will be the effect on the currency market? Will the dollar finally weaken? Now, here I do think we're going to get what we expect. We would expect the dollar to weaken. I don't think it's going to happen soon. I think 9 to 12 months from now, we'll start to see currency weaken. All right, that's when I'd start chasing or start preparing, start positioning for currency weakness. I wouldn't start preparing for it now. Right? It's too early. It's too early. The safe haven status of the U.S. throughout all this turmoil, of course, has supported the dollar, and I would not fight the tape on this one. I think we're going to be in this strong dollar environment here for, again, 9 to 12 months. Eventually, it will shift in response to all this debt issuance, but not immediately. All right, so that was number 3. What was number 4? Number 4 was how it will affect the commodity markets. You would expect this debt issuance to also be a good thing for gold and for perhaps silver or some of the other precious metals. And I think that will happen. I do believe your gut reaction out of that one will come true. Now, my only concern, well, let's first talk about the anti-dollars. What we're really talking about here are the anti-dollars, whether they're some precious metals, perhaps it's a Chinese currency. Some people would even say Bitcoin might be the anti-dollar here, right? So it should favor essentially all those factors you consider to be the anti-dollar. But my concern with gold right now is when I look at the gold-silver chart, right? So this is the price of gold denominated in the silver prices. That thing is just off the charts. That's off the charts. So if you wanted to play this from a precious metal perspective, I think I'd look beyond gold. I'd look at some of the other precious metals to try to play this. All right, so let's go back and run through this. Again, will this $3 trillion and plus, remember the $3 trillion just to start, will this cause rates to rise? I don't think so. Will it generate inflation? You would think so, but I don't expect that to happen either. Will it weaken the dollar? Yes. Just as you would think it's going to happen, I think it will come to fruition. I just think we have to wait on the order of 9 to 12 months for the dollar story to start developing here. And again, the effect on precious metals, right? You would expect this to be supportive of anti-dollars, and I think that's going to happen as well. All right, so that's our message for today. I'm Don Rich. You just experienced a rich insight. I hope you've enjoyed this. May your beer be colder than the company you keep. We'll talk again soon. Thank you.